October 6th, 1973. It is the holiest day in the Jewish calendar, Yom Kippur. And after that war started, is one of the most dramatic, more devastating, and most educational case studies in the history of investing. And here's the thing. The same forces that destroyed portfolios back then, they're still alive and operating in the world right now. So I'm going to walk through this chart that tells this entire story. We're going to read it together, line by line. And by the end of this video, you're going to understand exactly what happened, why it happened, and what it means for you thinking about your money today. So first of all, let's break it down what we're actually looking at. That is very important. First of all, the title. At the top says a 3-week war. That is our anchor. This whole chart is telling the story of what happened to financial markets because of a war that lasted just 3 weeks. Again, when you look at the bottom of the chart, that's your timeline. It runs from January 1973 all the way to the end of 1974. So we're looking at roughly 2 years of market history. Think of it like a road. You start on the left and you travel to the right through time. Now look at the left side of the chart. You'll see some numbers, 60, 70, 80, 90, 100. These aren't dollar prices. They are what's called the rebased index. Both lines, the blue line and the red one, both start at a value of 100, and that's the baseline. It was set on October 6, 1973, the exact day the war started. So when you see either line go above 100, that means it went up. And when it started, and when you see it go below, that means it went down. That's basically what it shows. So we start at the same time. Think of it like this. Imagine two runners, both start at the same starting line on the same day. One runner is the US dollar, and the other runner is a stock market. The chart shows you exactly where each runner ended up after 2 years. Now, there are two lines on this chart. The blue line on the top, that's the US dollar index. It measures how strong the American dollar is compared to other major currency around the world. And that's important because you want to understand what you're looking at. The red line is starts near the top as well and ends up way down at the bottom. That's the S&P 500. That is the stock market. It tracks the 500 largest companies in America. When that red line goes down, it means the average investor is losing money, a lot of money. Now there's a dotted vertical line. See that dotted vertical line running up and down around October 1973? That's the moment everything changed. That is when Yom Kippur War began. Everything to the left of that line is the world before the war. Everything to the right is at what came after. And here's what makes this chart so powerful. The moment that dotted line appears, you can literally see the two lines splitting apart. The blue line that shoots up and the red market line falls off a cliff. That divergence, that split is the story. Let's talk about why it happened so you could maybe draw some conclusion as to what's going to happen in this market under this particular war. But real quick, if this kind of analysis is new to you, and let me explain to you how to read the chart. So this channel is dedicated to one thing, making financial markets understandable for regular people. Regular people who want to protect and grow their money with real knowledge. So if this resonates, don't forget to subscribe. And every week I provide content like this not as a financial advisor, but as an educator on my channel and for my members. Okay, so back to the chart. Because this is where things get really interesting. Let's set the scene. It's 1973. The United States has just come out of the 60s, a decade of protests, social upheaval, and the Vietnam War. the U.S.'s economy is feeling the strain. Inflation is creeping up. Does this sound familiar? And globally, tensions in the Middle East have been simmering since the 1967 Six-Day War. Does this sound familiar? Where Israel captured significant territory from its Arab neighbors. Egypt and Syria want that land back. And on October 6, 1973, knowing Israel would be at its most vulnerable, the holiest is most sacred, they strike. The war lasted about 3 weeks. And Israel, after early setbacks, eventually pushed back with massive U.S. military support. And ceasefire was declared on October 25th. 3 weeks, that's it. The actual fighting, 3 weeks. But the financial consequences, those lasted almost 2 years. And that is what this chart is showing you. And here's why. The Arab member nations of a group called OPEC, the Organization of Petroleum Exporting Countries, they were furious at the United States for supporting Israel. So they did something that shook the entire global economy. They turned off the oil tap. That is known as the Arab Oil Embargo of 1973. OPEC stopped selling oil to the United States and its Western allies overnight. The price of oil quadrupled from about $3 a barrel to around $12 a barrel in a matter of months. Now think of what oil means. Oil isn't just gasoline for your car. Oil is the engine of the entire economy. It powers factories, it heats homes, it moves goods across the country. When oil quadruples in price, everything gets more expensive. That was the match that lit the fuse, and the explosion you can see right here on the screen is the red line collapse. Let's look at the blue line. The dollar index, notice something interesting. Before the war starts in the first half of 1973, the dollar is actually falling. It's declining. It was already under pressure from economic problems in the US. Inflation was rising. Does this sound familiar? The economy wasn't great. When the war starts and that blue line does a complete 180, it starts climbing. Does it sound familiar? And climbing until by early 1974, it's up to 15% from where the war started. That dashed circle in the chart, right around January to April 1974, that is the peak of the dollar's rally. Why does war cause the dollar to surge, as it is surging right now? This is really important concept that plays over and over in history. When the world gets scary, when there's conflict, uncertainty, instability, global investors do something instinctive. They run to safety. And for the last 80 years, safety to the global investor has meant one thing, the US dollar. Think of the dollar like a financial bunker. When the world outside gets dangerous, people crowd into the bunker. All the demand for dollars from investors in Europe and Asia and Latin America, all wanting to hold dollars, drives the price of the dollar up. But there's a reason why the dollar surged significantly, specifically in 1973, and this one is crucial. Oil is priced in dollars. It's been that way since 1940. Every barrel of oil on the planet, from Saudi Arabia, from Iraq, from Venezuela, is bought and sold in US dollar. That is what is called the petrodollar system. So when oil prices exploded, when the cost of every dollar quadruples, countries all over the world suddenly needed 4 times as many dollars to buy the same amount of oil. Demand for dollars goes through the roof, and when demand goes up, the price goes up. That is your 15% dollar rally. Looks like the victory on the chart, doesn't it? The blue line surging upward, looks strong, looks powerful, but look at what's happening to the red line. The red line at the exact same time fell 45%. That red line, the S&P 500, is one of the most heartbreaking lines I've ever studied. And I say heartbreaking because that wasn't just a number on the screen. This was people retirement savings. This was people college funds for their kids. This was real families watching their financial future evaporate. Look at where the red line starts when the dotted line appears. Right around 100. And then look at where it ends up by October 1974. Just 1 year later. It bottoms around 57 or 58. That is a 50 to 43 to 45% drop, right? 58. Nearly half of everything is gone. So why did stocks collapse so hard, so fast, so consistently? Let me walk you through the chain reaction. Step 1. Oil prices go up. That's your trigger. Everything throws on that. Step 2. Energy costs explode across every industry. Airlines, factories, trucking, companies. Everything that use energy, which is basically everything, suddenly has costs that are dramatically higher. And when your cost goes up, but your sales don't go up immediately, your profits get squeezed badly. Step number 3. Consumers get hit too. Gas lines stretch around city blocks. Americans are waiting hours just to fill up their cars. And why they're doing that? They are spending a massive chunk of their paycheck on gasoline alone. That leaves less money for everything else. Spending slows down, business slows down. 4. Inflation explodes. When energy prices go up, prices for almost everything go up. This is called cost push inflation. The government and the Federal Reserve, America's central bank, have to respond. And they respond by raising interest rates. Sounds familiar? I mean, they haven't raised it yet, but they're talking about it now. Step number 5. And this is the killer for stocks. While interests rise, borrowing gets more expensive. Companies can't borrow money cheaply to grow anymore. And here's the other thing. When you can earn a safe guaranteed 8 to 9% return from a government bond, why would you take the risk of owning stocks? Money starts leaving the stock market, and it just keeps leaving month after month. That is a slow, grinding descent you see in that red line. Notice there are some little bumps upward along the way. Investors kept hoping the worst was over. They'd buy on the dips. Then reality would hit again and the market would fall even further. That is one of the most dangerous patterns in investing. What we call catching a falling knife. You think it's a bargain. Turns up, it has further to fall. So by October 1974, exactly 1 year after the war began, the market finally bottomed. It had lost nearly half of its value. And it would take years for investors to fully recover. Now, there's something really fascinating that most people completely miss when they look at this chart. I want you to burn this into your memory because it's one of the most important relationships in all of investing. The dollar and stocks move in opposite directions. When the dollar surged by 15%, stock crashed 45%. When the dollar eventually came back down after hitting its peak in early 1974, stocks started very slowly and very painfully trying to recover. That inverse relationship, this tendency for the dollar and stock to move against each other is not just a historical curiosity, it's a fundamental pattern that plays out in financial markets over and over again. Here's a simple logic. When the dollar gets very strong, it makes American companies' products more expensive for foreign buyers. Think about an American car manufacturer. If the dollar strengthened, their cost that costs more for someone in Germany or Japan to buy. Sales fall. Simple as that. A stronger dollar also means any profit the company earns overseas are worth fewer dollars when converted back. So even profitable international companies feel the squeeze. That's the reason why the president and the U.S. administration wanted a weak dollar, although you're not supposed to say that. And there's a deeper psychological element too. When global investors are scared enough to pile into the dollar, when fear is that high, That same fear is pushing them out of stocks. Fear of greed, right? Fear and greed, risk off and risk on. These are the two fundamental modes of the global financial systems. When the world is in risk off mode, when fear dominates, people want safety. Dollars, US government bonds, gold. I don't know. Now it's not really happening. We have to look into that. When the world shifts to risk on, when confidence returns, money flows back into stocks and back into growth assets. Look at this chart one more time. The moment the war starts, it's a massive risk-off event. Dollar surges, stocks collapse. It's literally the chart of a global fear. Just what's happening right now. And the war didn't last that long then. And now we get to the question that actually matters. Because if I've done my job right, you're probably thinking, okay, this is fascinating. It's great, but we're now in 2026. Why should I care about something that happened 50 years ago? We live in a world today where geopolitical tensions, as you could see, are escalating on multiple fronts simultaneously. You have the ongoing conflict in Ukraine. You have what's happening in the Middle East right now with Iran and Israel and the US. You have growing friction between the United States and China over Taiwan. These are not abstract concerns. These are the kind of geopolitical flashpoints that, if they escalate, trigger exactly the same kind of reaction that you're seeing in 1973. That playbook hasn't changed. Energy disruption, dollar surge, stock market decline. What has changed is the speed. In 1973, things played out over months. In today's hyper-connected, algorithm-driven financial world, those moves can happen in days. So what do you actually do with this information? Number one, my members should know this. Pay attention to the dollar index. Make it an habit to check the dollar index, the DXY, the same way you check your stock market, because a surging dollar is often an early warning sign that something big is happening in the world that could impact your stocks. Number two, don't be alone in stocks. The 1973-74 crash is a brutal reminder of what concentrated stock exposure can do to a portfolio when macro conditions turns against you. Historically, history has shown that assets like gold, certain commodities, and even treasury bonds can provide a buffer during these risk-off environments. Number three, think about energy. Whether you own energy stocks, whether you think about how energy price affect your other holdings, whether you look of how the geopolitical risk in oil-producing region could ripple through your portfolio, energy is a thread that runs through almost every major market crisis in modern history. It was true in 1973, and it's still true today. So let's bring it all together. October 6, 1973, three-week war in the Middle East triggered oil embargo. US dollar surged 15%, crushing stock market by 45%. So this chart that we look at shows you a high story perfectly, right? Two lines. It shows you how geopolitical shock can affect the stock market. That lesson is not that you should panic every time there's a conflict in the world, because eventually it recovers. But the point is that the S&P eventually came back from that 45% drop. But the lesson is that understanding these historical patterns gives you an enormous hedge. When other investors are panicking without understanding why things are moving the way they are, you have the context, the framework. You are calm to make better decisions. That is the idea behind the Black Swan. I want you to understand the risk. So when you're taking a decision, you stick to it and you don't panic because you understand the risk. If you haven't subscribed yet, please do so now. Please join this channel. Understand what's going on. Learn a thing or two about a thing or two. We need more thumbs up. Only 9 thumbs up out of 57 people.